Hi, it's Keith here, and welcome to today's 5 with Fitz. Thanks, as always, for joining me. You know, I didn't like the way the wind was blowing after hours last night, so I sent out a tweet via X urging people to be cautious in case there was some selling this morning. And you know what? It looks like I may have been onto something. Stocks are down a skosh as I record this to start the second half of the year. Is this a big deal, or is this a moment? Well, there are folks like hedge fund billionaire Robert Citron making the case for a correction starting right about now, but there are just as many folks making the case for a generational opportunity a la BlackRock's Rick Rieder. Now, I don't really care either way. Why? Because I think that is the wrong question. If you want to guess about which way the markets go, then fine, do all the guessing you want. I don't, right? I'd rather concentrate my efforts on finding great companies that will A, succeed anyway, and B, that'll be there when I need them. Why? Because history shows very clearly that it almost never feels like a great time to invest, but almost always is. Let that sink in. Anyway, here's my playbook today. Number 1, mess with the bull, get the horns. It was only a matter of time, I told an audience in Dallas recently. For what, you ask? For two of the biggest egos on the planet to clash, i.e., U.S. President Donald Trump and Tesla's frontman Elon Musk. Now, President Trump has threatened to cut subsidies for Elon Musk companies, calling him the most subsidized human in history and suggesting that the Department of Government Efficiency, DOGE, investigate his funding. Now, Musk, of course, has slammed Trump's tax bill as debt slavery and called for a new political party. It would be logical to expect elevated political risk for Tesla, SpaceX, and Starlink as Trump seeks leverage for upcoming budget negotiations. So what do? Buy, sell, or hold? Well, if you're a trader, volatility is your friend. There are literally dozens of short-term strategies you could use to play this, ranging from simple directional options to complex spreads on volatility itself. If you're an investor, volatility is also your friend. A lot of people forget that. You just use it differently. In this case, you need to think about the bigger themes here and take action that keeps you lined up with them, using the right tactics, of course. Now, I know what I'm going to be doing, and hopefully you do too. By the way, if you'd like some help threading this needle because you are uncertain, you might enjoy One Bar Ahead, where I detail specific stocks like Tesla, funds, and strategies for both, using an approach that investors around the world have told me that has changed their lives. I say chill. Tesla has returned 18,822.99% as I record this since its IPO. The S&P 500 has turned in a respectable 494.79% over the same time frame. Tough love time. If you're worried about a few bucks here and there and a few percent on a day like today, you're not an investor, but a speculator. Either is fine, to be clear. Just don't kid yourself, please. Number 2, Zuck's Brain Power Blitz. Meta just launched Meta Superintelligence Labs, a brand spanking new unit to consolidate all of its AI foundation models, projects, and research under one ominous sounding roof. Now, who's running the show? Well, Alexander Wang, an ex-Scale AI CEO, Nate Friedman, ex-GitHub CEO. Both were recently poached, hired, to turbocharge Meta's AI efforts against OpenAI and Google. I think that's the wrong target, but that's moot. Zuck's not messing around. These hires aren't cheap, and neither is the $747.90 share price that Meta hit on Monday, a new all-time high that topped its February record. Now, my POV is that Zuck doesn't like second place. And when he starts throwing billions at brainpower, you can bet he's aiming for the crown, right? AI is an arms race. If you're investing in the combatants, do me a favor, pick the ones that are buying the smartest weapons, not just the shiniest ones. Number 3, we've been talking about this one for quite some time, but Home Depot's growth hack. Just buy it. Home Depot bought building products distributor GMS for $4.3 billion, right? The move ends a brewing bidding war with billionaire Brad Jacobs' QXO, which had offered $5 billion and threatened a hostile takeover if rejected. So why the splurge? Well, DIY sales are slowing, something we've been talking about for a long time, and why I have repeatedly encouraged you to avoid both Home Depot and Lowe's. Professionals, meaning electricians, roofers, contractors, etc., spend more, spend often, and aren't as sensitive to every headline about mortgage rates or unemployment. Home Depot expects the deal to close by 2026, early 2026. Now, Wall Street is probably going to cheer this as some sort of strategic diversification, but that's not the right thought here. Let's call it for what it really is, defensive buying. Here's why. When consumer demand weakens, companies either shrink or pivot to where the money still flows because, repeat after me, money always flows to where it's treated best. Say that again. Money always flows to where it's treated best. This deal tells you exactly where Home Depot thinks the real money is. And contrary to what many talking heads and self-styled pundits will tell you, it's not suburban families buying mulch and ceiling fans on the weekends, folks. Keith's investing tip. When you see a company buying growth, look deeper. It's always good to ask, are they extending existing advantages or are they just patching cracks in the foundation? Pun absolutely intended. There's a world of difference, and your money deserves to know which is which. So, by way of a trade idea update, I suggested a pairs trade on something like this a while back, meaning buying and selling two different retailers simultaneously. That's what a pairs trade is, Walmart and Home Depot. Now, the former has returned 12.96% over the past 3 months, while the latter has tacked on just 0.91%. So far, so good. Number 4, open AI sourcing. There is no free lunch. Now, Huawei just open sourced 2 AI models under what's called its Pengu series. Now, loads of folks are thinking, cool, open source, because, collaboration, innovation, and community, right? Think again. Open sourcing is bait, right? The real goal is to hook developers into Huawei's Ascend AI chips and expand its ecosystem dominance, especially at a time when NVIDIA remains blocked from selling its top-tier chips to China. Now, Huawei is playing a different game here, right? While Baidu builds general-purpose models, Huawei focuses on very specialized AI for government, finance, and manufacturing. It doesn't need to beat DeepSeek or Baidu in software. It just needs to sell more hardware. So let's be really clear. Their chips may not match NVIDIA's high-end inference capabilities today, but like many things in China, give them time. Why? Because Beijing has very little regard for intellectual property and has all but turned reverse engineering into a national sport. Harsh? Yeah, I know, but look at history. Keith's investing tip. This is a big one. Many investors struggle with China for one reason or another. But there's really only one thought here, and it's a big one. The dragon is coming to dinner next Tuesday, which means you've got to decide if you're going to be at the table or on the menu. It's that simple. And finally, number 5 today, Amazon's robot army hits 1 million robots. Yeah, 1 million. That's a lot of zeros. Amazon just deployed its 1 millionth robot across operations. Now, cue the Luddites. One particularly salty anonymous keyboard warrior recently came at me with a full cap, "So what?" in response to something I said about robotics. Aside from the fact that yelling online, because that's what all caps are, they're the internet version of screaming, it doesn't make you right. It just makes you obnoxious. And this particular individual didn't offer a single fact, idea, or even halfway coherent rebuttal. Just anonymous jabbing from behind a screen somewhere on the planet. Meanwhile, in the real world, Amazon just deployed its 1 millionth robot, right? That's not science fiction. This is what exponential adoption actually looks like, and it's not surprising. Robotics isn't coming someday like many think. It is already here, and no amount of snarky anonymous commentary is going to stop it. The Industrial Revolution took decades, but this is happening in quarters. Every industry on the planet will adapt, adopt, or die, a point you've heard me make repeatedly about robotics, AI, and a number of other themes that we're following in one bar ahead. That's the real so what here. So, make sure your money's on the right side of history. Take a look at the 6-wave chart I share with you every once in a while in the written version of the 5 with Fitz, because that's really going to hammer this home. Everything is happening bigger, better, and faster now. And meanwhile, I'll be here if you need me. Today's bottom line, people want to make investing very complicated because they think that's what they should be doing. Well, in reality, you've only got to get 2 simple things right as an investor. Number 1, you got to buy the world's best companies making must-have products and services when nobody wants them and selling when others can't resist buying them. And 2, you got to keep risk as low as possible at all times. Now, as always, and on that note, let's make it a great day because that's what we have in front of us, especially here in the sunny Pacific Northwest where I've just had a great workout and I'm in a really good mood as a result. You got this, I promise, and I will see you tomorrow. Thanks as always for watching and spending a few minutes of your time with me today. Cheers.